Platforms started providing commission-free trading to encourage as many people as possible to use their service. Social media provided a haven for the culture around finance. Memes became popular and eventually turned investment-worthy, most notably GameStop and AMC. GameStop was a struggling video game retailer that was popularized on Reddit. GameStop was, and still is, the lead retailer when it comes to purchasing physical copies of video games. Consoles, merchandise, and collectibles were also sold there. Over the years, however, stores began shutting down to an increase of online shopping, while institutions had a strong short position in the company. The discussions on Reddit turned the dying retail chain into a meme, and over time, it gained enough interest from buyers to hike the volume up enough to cause a short squeeze. Big institutions that were heavily short on the stock were forced to cover and take the loss while the company's stock price soared. Similar incidents happened in 2021. AMC was another example of a company that was nearly out of business before it was bailed out by the online communities. These online groups would start to gain some serious influence in the mega bull market of 2020 and 2021. By no means did the cinema and gaming company hold any real value during this time, but the price was considered cheap because they traded at $20 or less. Regardless of their poor valuations, GameStop ended up making over 2,400% by the time it had reached its peak on January 28th. Similarly, AMC flew to 1,400% in June before its 80% decline from the highs. In our content, you may have noticed that we occasionally use our own proprietary software to research the markets. This market scanner is called the A1 Edge Finder, and it is a tool our team has spent a lot of time designing and updating. The scanner imports data on things like retail positions to see what retail traders are buying or selling. It also imports bank and hedge fund positioning so that we can get an inside look at what the big players are up to. Of course, we pay attention to fundamentals, so we program the tool to grab economic data in real time to help keep us up to date. If you'd like a copy of the tool yourself, we're doing a major subscriber discount when you use code A1YT at checkout. In the description below, you'll find a link to get access to the tool. By purchasing our software, you'll be supporting our research videos here, as well as getting access to an amazing tool. Again, use code A1YT down below. Now, back to the video. Big faces in the financial world, most notably Mark Cuban, advocated for this type of action, as it was kind of a victory for the average investor. He went on to thank the Wall Street Bets community for their effort to take on Wall Street, as well as hold on if they could afford to.
And Mark, I want to hear your thoughts on this, because I get it. I love the sentiment of being able to stick it to the hedge funds, and what the hedge funds have been able to do in some cases has been really, really bad news. But if you're manipulating market prices, I don't see how that's a good thing really in any scenario.
How's this any different than what every brokerage firm does? You know, we've been talking about get long, get loud for generations.
It's not good for the brokerages to be doing that at all either. I'm not defending that. It's just when you see moves like this, it's a little crazy. And I wonder what Doug Parker is thinking. I wish we could get him back on to ask him what he thinks about his stock being up better than 50%, because I would think that makes a company pretty hard to run too. How do you live up to those expectations now?
Oh, but they're not expectations at all. I mean, look, the reality is you just have to run your company and do your best. It doesn't change the fundamentals of the company at all. You know, it so many respects is window dressing. And if you are an owner of American Airlines, if you're an owner of GameStop, hopefully, you know, prior to all this, hopefully you owned it for a good reason and you believe in the company. And all the not even manipulation, all the swings in the price of the stock, it's all just mishigas, right? I mean, if it's a good company, it's a good company. If it's a bad company, it'll end up going out of business. And, you know, the people who, you know, bought it just to speculate, some will make money, some will lose money, but that's just the way the market's always worked.
Such actions made headline news as the subreddit gained national attention. What is key to understand here is that the events like this only happen during the most unprecedented time of bullishness in the stock market and risk-on sentiment around the world. With every tweet from Fed Chairman Jerome Powell, the market would swing. People really started to pay attention to the news more, and it seemed that everyone wanted to get in on the stock action. The number of brokerage accounts in America exploded by over 10 million in the first 2 months of 2021. The amount of money added in the markets also has something Wall Street has never seen before. It seemed that retail had so much more power than before. and institutions played into the hype of every new stock pick. Retail money flow paired with the Fed's expansionary stance followed by social media promotion took the stock market to a concerningly high level. At this point in time, people were making much more than previous years just by holding on to their positions, and those who were in the growth sector saw tremendous gains. New names came out of the bull market, like Cathie Wood, the ARK Invest founder and CEO, who only purchased the most speculative growth plays. For a while, those picks worked heavily to her firm's advantage. As long as borrowing costs were as low as they were, and trillions of dollars continued to back the stock market by the central bank's balance sheet, you made money. The United States Federal Reserve, however, had their own plan in mind. In the summer of 2021, tapering was the prime focus in the FOMC meetings. For 2 years, the Fed did what they called monetary easing, which was basically devoting their virtually unlimited balance sheet toward the expansion of the stock market and economy. Jobs weren't necessarily being added at the same rate of which stocks rose, but the job market was at least recovering from the pandemic. For the first time in years, individual investors were making more than funds themselves. At the start of 2022, however, the Fed planned to start the opposite of easing called monetary tightening. Now that the economy had basically recovered most of what it had lost in the pandemic layoff, it was time to start focusing on the dollar. Inflation was rising at record rates as the value of the US dollar sunk lower and lower. When January of 2022 arrived, the Fed made its move, decreasing its balance sheet while exiting the market slowly. Once March hit, the market changed. The Fed's balance sheet hit zero, and interest rates were on the rise. Without a monetary backbone in the market, a higher funds rate shook the market for the worse. On the first trading day of the year, stocks fell on poor sentiment, and things only got worse from there. Up until now, the market is down 23% from all-time highs in 2021. And investors fear that this is just the beginning of a bear market. The world is now seeing what it's like without any help from the Fed after experiencing one of the biggest market bubbles in history. A market that was inflamed beyond what anyone had expected is now about to burst according to analytics, and we are only seeing the tip of the iceberg. Investors fear that the market might be in store for another 20% drop, which is much worse than the previous estimates. As concerning as this sounds, this type of move might be what the market needs to put an end to the bear market. However, that would put the S&P near $3,000, the NAS 100 at 9,200, and the US 30 at 24,000. Investors may have to hold on if they can afford to until then. This lingering fear of another sell-off may keep investors at bay until concerns begin to fade. Analysts and traders believe we are already in a recession, judging by the stock market's performance in 2022, but the storm might not be over yet.
Cathie, one broader question and then a specific stock question. When you think, though, about the last year and you think about your approach, what is the lesson in it? Meaning, I know you have a North Star about specifically these stocks that you're talking about, but at some level, you have to look around, and I think your investors would want you to look around and say, okay, I was wrong. What was I wrong about? And if I was wrong, how am I going to change my approach in the future?
So if we were wrong on one thing, and that was inflation being as sustained as it has been. Supply chain, I can't believe it's taken more than 2 years. And Russia's invasion of Ukraine, of course, we couldn't have seen that. So inflation has been a bigger problem. But I think that it has set us up for deflation. I've been listening to your program. I heard Ken Langone talk about being in recession now. Jeremy Siegel, same. We think we're in a recession, and we think a really big problem out there is inventories, the likes of the increase of which I've never seen this large in my career. And I've been around for 45 years. And we're talking about the best managed companies in the world. If you're talking about Walmart and Target, they know how to manage supply chains. So if they have problems, we think there are a lot more problems.
Either way, we have seen the greatest financial institution in the world cause an unstoppable bull market to an unrelenting sell-off. And now the world waits for the Fed's next move.